I'm Matt Bishar with NAREIT.com here in New York City for REITWeek 2015. Joining me for this CEO Spotlight is Gordon DuGan, Chief Executive Officer with Gramercy Property Trust. Gordon, thanks so much for joining us.
Glad to be here, Matt. Thanks for having me.
Now, when we spoke last in December, you mentioned that Gramercy was finding good deals on assets in the office and industrial space. How did that hold up in the first half?
Well, we've been very active so far this year. We've closed over $600 million in acquisitions, $400 million of which we closed in a 12-property portfolio acquisition that closed in March. And I think the dynamic in our industry has changed where we're now competitive buyers of portfolios of assets. And as we've gotten larger, that's going to be key to continuing our growth. We've been one of the fastest growing REITs in the U.S. And buying portfolios will be a way for us to continue that growth going forward.
And Gramercy received an investment grade rating from Moody's last month. Can you give us an idea of what this will mean for your company going forward?
I think it's a very important milestone. To be an investment grade rated company means that we have access to the corporate debt markets. We can do long-term financing, 7, 10, 12-year financing. And as we're able to do that and move away from our current capitalization, which has a reliance on bank financing, I think that will show up in a better equity multiple is where it eventually ends up. We have very little floating rate financing today. So it's not so much the ability to go fixed, but it's the ability to go 7, 10, 12 years out with the maturities, whereas the bank financing term loans that are available to us fixed rate are 5 and 7 years. So I think it's a huge milestone. We've gone from taking, when we launched Gramercy, we're less than 3 years, we're an investment grade company. It's remarkable, but it really goes to all the hard work everybody's put into it.
And earlier this year, Gramercy's European Property Fund made its first acquisition. Can you talk a little bit about the strategy for the company's European arm?
In my old role at W.P. Carey, while I was there, we had a very significant European presence. And the business plan for Gramercy was always to, at the right point in time, look at an opportunity to grow the business through a European expansion. We announced it in December. We raised 300 million euros of outside capital, committed 50 million of capital from our own balance sheet, and purchased a platform in London so that we had immediately an fully integrated presence in Europe. We have tax, financial reporting, asset management, investment expertise, and we're going out to buy single-tenant assets at what we think are very attractive returns. I would say that Europe is less competitive than the United States, and its recovery is further behind the United States. So it's a bit of an exaggeration, but it's not too far off to say it's like jumping back in a time machine to go back to 2010 or 2011. We don't get to do that very often. So, we're very excited about the opportunities there.
Great. Gordon, thank you so much for joining us.
Thanks, Matt.
For more on this and other REIT news and analysis, be sure to visit REIT.com.